Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm very excited for this episode. I feel like we're really doing well in the podcast game when we are able to get guests on that we've admired for a long time, names that we were familiar with when we were starting to invest. And we've got a big name in the Australian finance industry here, so I'm very excited to unpack his his method and pick his brain.
It is our absolute pleasure to welcome Geoff Wilson to the show. Geoff, welcome to Equity Mates.
Thanks, Bryce, and thanks, Ren. I've heard a lot about you guys too, so it's mutual. It's mutual. And to me, what you guys do is fantastic because, in terms of investing in the market, the quicker and the earlier people can learn about it, to me, the better. And you just put a great way of communicating to people. So congratulations.
Thank you. Appreciate the comments. So for those of you who haven't come across Geoff before, Geoff is the Chairman and Chief Investment Officer at Wilson Asset Management. With over 41 years experience in investment markets, Geoff founded Wilson Asset Management in 1997 and currently oversees 8 listed investment companies. Geoff has also led the creation of Australia's first listed philanthropic wealth creation vehicle, Future Generation Australia and Future Generation Global, which we'll be unpacking a little bit later. So look, a lot to chat about, but as always, we start with our overrated, underrated game. So let's get stuck in.
That's right, Geoff. We'll throw a few themes, indexes out and just get your thoughts on whether they're overrated or underrated by the investing community at large. So we'll start at home and we'll start with our benchmark index, the ASX 200, overrated or underrated?
Overrated.
And why is that?
Yeah, it's just an index. So it gives you the average and it's mainly dominated by the big banks. So if you really want to perform, if you take out the big banks and you're looking for growth companies, and you're a good investor, you should be able to do better than the All Ords, I'd say.
Would the same answer then apply to the NASDAQ 100, overrated, underrated?
Oh, can I do fairly rated?
You can, yes.
You can.
Is that a new category?
We've actually had someone from Vanguard on and they said everything was fairly rated.
Neutral.
Neutral. Which is very on brand for them.
Yeah, that's right. And I'm not a believer in indexing, so that's probably an error. So maybe I'll say overrated. Just to just had a phenomenal run. Obviously there's a lot of risk in the market, and there's a lot of froth and bubble in the market, and that's mainly been with low interest rates, the money's gone into technology companies that are showing great growth and mightn't have any significant valuation protection on the downside. So I'd say overrated there.
Well, speaking of froth and bubble, Geoff, overrated or underrated Bitcoin?
Can I put it grossly?
Yeah,
grossly underrated.
Grossly overrated.
Fair call. Overrated or underrated? Full service brokers.
Full service brokers overrated. Yeah, everyone is a good investor, and they just need to spend the time, doing the research and doing the analysis.
And then finally, Geoff, overrated or underrated Australian residential property?
Oh, so difficult because I would say slightly. I would say overrated. It's just had a phenomenal run. But unfortunately, with these record low interest rates, all asset classes are probably more on the overrated side from my perspective.
So let's start at the start before we get stuck into some listed investment company discussion. We always love to hear the story of our guests' first investment, as there's probably a lesson or two to be learned. So are you able to share with us the story of your first investment, Geoff?
Yeah, and probably just before I go, from the first company I bought shares in was the first real company I was aware of. I grew up in Melbourne in my sort of mid-teens, and my dad would work quite late. He'd come home, and after dinner, he'd always sit down and he'd read the paper, and he spent an enormous amount of time just looking at one page with a whole lot of numbers and everything on. And I remember saying to him, "Look, what are you looking at?" And he said, "Oh, that's the stock market." So I remember looking down the list for something I could afford, and there was a little company called Cox Brothers. It was a retailer in Melbourne, and it was trading at half a cent.
Jeez.
And then, and then I thought, well, gee, I can afford that. And then another time, I looked, a few weeks later, it was at 1 cent. And I thought, geez, if I'd bought them at half a cent, I would have made 100% on my money. Anyway, then a month or two later, I went looking for them and I couldn't find them. And I said to Dad, where have they gone? And he said, oh, the company's gone under. And that's probably why I always, in terms of retail, I've sort of understood that retail is a very tough business. The first actual company I bought was a similar story to that. It was really not understanding that when you buy a company, you become a part owner of that company. It was really just thinking about, is there some leverage and can I make some money? And it was in the late 70s, early 80s. Malcolm Fraser was in, and there was this talk about a resource boom, which never came then, but came a few decades later. And I was looking down again for the cheapest company. I had a little bit of money, $1,000, and I found the cheapest company I could find was a company called Timor Oil and Gas, and they were trading at 10 cents. So I bought $1,000 worth of those, and my logic was if they went to 12 cents, I'd make 20% of my money and I'd sell. And they actually went to 12 cents. I sold half of them, and then they ended up going to the mid-30s, and where I sold the other half. Now, I hadn't even done any research on it, and later I found out that they were oil and gas company, and they were drilling for oil. So that's why the share price went up. They didn't end up finding it, but I suppose that was my first investment, and just as a total novice, knowing nothing about the market, and I lucked out. So that was the first stock I bought. Since then I've learned that when you buy into a company, you become a part owner of that company. So you really should understand that you want to be a part owner of whatever business you buy into. But Timor Oil and Gas was my first stock that sort of blooded me.
Nice.
Well, from there to now, you've had a pretty phenomenal career in investment markets and finance. Over that time, have you developed a personal investing philosophy?
I tend to like to be a bit counter-cyclical. What I've always done is I've always backed management. I believe it's. I suppose the people listening to you, today are they're backing you as individuals and getting good guests on it, and so they're backing you. Or if anyone invests in any of our companies, any of the WAM companies, then they're backing myself and the people that manage the money. So when you buy shares in a company, you're a part owner of that company, but it's so important the person that's managing that company for you. So management is incredibly important. I've also, over a long period of time, believe the greatest correlation between a share price and anything, whether it's yield or asset backing or cash flow or return on equity, all the studies I've shown, it tends to be earnings per share growth. So there's that strong correlation. So you want a company that's got growing earnings, and our sort of philosophy of how we invest our money is buying undervalued growth companies, so companies that are growing earnings strongly, and when we can see a catalyst is going to change the valuation of that company, because companies can be cheap for a long time, and if you really want to get the maximum bang for your buck, so you're better off sitting in cash until you can see something. Find a well-managed company, that's got good earnings growth, but you've got to then identify, if you want to get a better return than the average, is identify what you believe is a catalyst or an event that change the market's view of that company, and that's the catalyst. And that's it takes you a little bit of work and experience to get to that.
Yeah. So, Geoff, Wilson Asset Management now manages 7 listed investment companies, soon to be 8, but we will touch on that in a second. Let's start with some basics. If retail investors want access to active managers, why listed investment companies over, say, unlisted managed funds or active ETFs?
Yeah, I mean, the interesting thing, about 30 odd years ago, I saw a bit of research from Morgan Stanley in the UK, which looked at, the listed investment company equivalents over there and looked at the performance of those, and that they're a closed-end pool of capital versus, the normal managed funds like the mutual funds over there, which is an open-ended pool of capital. And what it showed is the listed investment company equivalents had outperformed the normal funds by 1.5% to 2% per annum over a 50-year period, and that is significant outperformance. Now, why did that happen? Is because what the average investor that invests in the stock market gets about half of the market's performance. Say if the market on average does about 10% per annum, then the average investor, I think, makes it about 5% per annum, because the average investor unfortunately gets caught up with his emotions. And the toughest thing about investing in the market is you've got to work against your emotions. So the average investor will be buying towards the top and will be selling towards the bottom when they're scared. And what happens is also money that flows into managed funds, obviously the most of the money flows in when things are really good. And, say when, during the GFC or, when there's a big dislocation in the market, then the money will be, everyone want cash and they'll be pulling the money out. So therefore, if you're a fund manager and you've got an open-ended pool of capital, you're a forced buyer when everything's expensive and you're selling when everything's cheap. And the great thing about a listed investment company is, you raise money, say, with WAM Strategic Value, we're going to raise $225 million, not a cent more, and that's what we'll be managing. So when everything's going well and money's flowing into the market, we're never forced to buy. We can take a medium long-term view. When things are bad and money's flowing out, we're never forced to sell anything. So, we can really pick the eyes out of the market and pick up some great value. So that's why I like the listed investment company structure. Also, so in theory, I think there's a natural competitive advantage. Also, there is, you do have access to the board and the management, and you can give them a hard time if you want it. It can be very public. And also, what I like is that they can trade at discounts to the value of the assets, or discounts to, we call it NTA, what the net tangible assets of the company are, or at premium. So, and that is, to me, it's nearly unbelievable that I can manage a pool of capital and I know it's worth $1 and I can buy it for 80 cents. Or at other points in time, I know it's worth $1 and it could be traded at $1.20. So, of course, I'd be a seller if it's doing that. So that's why I like, so it's really, to me, an ETF's great for people starting off. And then I think, you can layer on, listed investment companies. If you just want a broad exposure to the market with your ETFs and your listed investment companies, your skill level's going up when you add listed investment companies. And then if you want to take a greater risk, then you do your analysis on individual companies and decide, whether you want to buy shares in Coles or Woolworths or one of the banks or some of the technology companies, etc.
Now, Geoff, you mentioned the Strategic Value LIC. We'll get to that in a second. Before then, we want to talk about how you, really started the movement in Australia to use listed investment companies to further philanthropic causes. So for people who are unfamiliar with the Future Generation Australia LIC and the Global LIC, can you tell us a little bit about what they do and how they use that LIC structure to further these causes?
Yeah, first off, I saw this done in the UK, and I just thought, what a phenomenal model. And so what it is, it's a listed investment company that's listed on the stock market. The two that we've set up, as you said, their codes, one's FGX and the other's FGG. FGX is the Australian, you get exposure to the Australian stock market. FGG, you get exposure to the global stock markets. And what it is, effectively, it's a real relationship between the investing community and that investment community giving back to society. And so all the fund managers that we've tapped on the shoulder in FGX, that's the Australian fund managers, or FGG, the global fund managers, we're allowed to put our money with those fund managers in their main funds, and they don't charge any performance fees or any management fees. So they're managing the money pro bono, but it's in their main fund, which they live or die by the performance. And that allows both companies, to give away 1% of the assets to charities, and that's focusing at children at risk and youth mental health. So both companies together are a little over $1 billion, so it's about $11 million a year. Because the fund managers are doing all this pro bono, we can give to those two areas. So they're fantastic. And if you look at them, the performance of the underlying managers are first class. The managers we've gone for are boutique, which they call boutique managers, and they are people that have really set up the funds themselves, and again they live or die by their performance. And I find that a boutique fund manager will outperform like just a big name fund manager because they've really got everything on the line.
It's a pretty incredible thing what you're doing, Geoff. People should definitely check those two LICs out, Future Generation Australia and Future Generation Global. Some people in the community may also be familiar with the Hearts and Minds LIC, which is doing a similar thing, using this LIC structure to further philanthropic causes. So it's pretty cool what both you and the Hearts and Minds guys are doing. And the Hearts and Minds, it's a great. I'm actually on the board of Hearts and Minds as well.
Oh, nice.
well, because I know the listed investment company, market incredibly well. And when Matthew Grounds and Gary West were putting it together, they asked if I wanted to be involved. And again, the Hearts and Minds, is a great product, and that is, very similar. Similar concept, similar philosophy. Really, giving the money to medical research. That's the area it's focusing on. Giving the money back to, and there are similar. Some of those fund managers that are managing the money for Hearts and Minds are also managing the money for FGX and FGG. They're all great companies, and really, again, you just do your analysis. See what the value of the assets are, and if you can buy those value of the assets, below their current value, then that's a good deal. And luckily, the two Future Generation ones are actually trading at sort of 8 and 12% discounts to their NTA. So you're getting, in theory, they're on sale at the moment.
Now, Geoff, we've talked about this discount to NTA a little bit, which I think leads us nicely into this new LIC that Wilson's about to launch. But look, before we touch on that, we are going to take a quick break to hear a word from our sponsors. So, Geoff, as I mentioned before the break, Wilson Asset Management are launching a new LIC, the Strategic Value LIC, ASX ticker WAR, which I like. That feels like it's sending a message with that. And really the problem that it's declaring war on is a lot of these listed investment companies that trade at a discount to their net tangible asset value. Now, for people who are sort of new to this problem, let's start by defining this problem, and then we can talk about how you're working to solve it. So why is an LIC trading at a discount a problem for investors?
The LIC trading at a discount, say if an LIC floats at $1, has $1 of assets, and then the share price, because there's more selling than buying, and as Warren Buffett says, the market's a weighing machine. So, the value of the company's $1, but say it's trading at 90 cents. Then if you paid $1, even though there's an asset, the assets are worth $1, but when you look up the share price, it's 90 cents. You don't feel as though you've got $1 of value. You feel as though you've got 90 cents of value. And if you have to sell, then even though the assets are worth $1, you're only going to get 90 cents. So that's sort of that's why it's a concern for some people. From my perspective, is as I'm a buyer of listed investment companies, I actually think it just is a great opportunity. You actually want them, these companies trading at discounts to asset backing, because it provides you're getting exposure, $1 of exposure to the market, and you're only paying 90 cents for it. If it's trading at a 20% discount, you're only paying 80 cents. So, to me, it's nearly too good to be true. Now, what happens is a lot of fund managers, when they raise money for a listed investment company, they mightn't have had a lot of experience in having a listed investment company, having a lot of shareholders, a lot of retail shareholders, and understanding how to communicate with them and how to inform those shareholders. And a lot of fund managers, when they raise the money, they actually think the day that it lists on the stock market is they've won the grand final. Now, from our perspective, it's when you list on the stock market, that's the end of pre-season training. And then a lot of the hard work begins. Now, what's important? If you're looking to invest in a listed investment company, what should you look for? You should look for the underlying performance of the manager. You need to look at, because a lot of people buying these are self-managed super funds, so they're looking for the dividend stream. So you want a growing stream of fully franked dividends. The third thing you want, is you want a company and a board that looks after shareholders. Like some companies, unfortunately, do things that destroy value for shareholders, like doing placements at discounts and taking money from the current shareholders and giving it to the new shareholders. So they've got to look after shareholders. And the fourth thing, and this is the part that most fund managers miss out on, is you really have to have a detailed shareholder engagement, communication, and marketing. And that's where you guys potentially fit in. So you really you need to do that, and a lot of fund managers don't do that. Like we manage, as you said, 7 listed investment companies, soon to be 8. We've got 100,000 retail investors in our listed investment companies. We've got emails for 60,000 of them, and also we're managing about $4.5 billion. So it's very important for us, to communicate clearly with those shareholders so they know what we're doing. Keep them informed, and what that does do, it actually swings the equilibrium from trading at a discount, to potentially NTA or a premium. And the interesting thing is, the 6 listed investment companies that we floated, WAM Capital being the first one, all 6 of them are trading at NTA, if not a premium. And the concerning thing, to an extent, is for the people that are buying it, like one of them called WAM Research is trading at 42% above the NTA. So effectively, there's $1 of assets and it's trading at $1.42. So that is definitely not on sale.
Well, look, if there are any LIC managers out there that want some investor relations help, we are the podcast to do it.
No, you are. No, you are.
No.
To me, you guys have got a great niche, and to me, you guys, you're plugged into the big growth area, they should pay attention.
Well, I'm actually so glad that you mentioned the marketing piece, because I've often spoken to Ren about. I've held LICs throughout my investing journey, and if you look under the hood, those initial things that you spoke about, quality of manager, are they paying a dividend, all of those things tick the boxes, yet they're hidden in a basement, in a far city, and no one knows about them. But unfortunately, given that they're listed on the stock market and at mercy of supply and demand and that sort of stuff, if no one knows about the stock, then they're always just going to be ticking away. So I think for me, that's one of the most important things when you're looking for LIC is how good are they at putting themselves out there and making people aware of what they're doing.
Correct. And it's a new skill for the fund manager, because he's, I think there was an article probably 20 years ago in the newspaper in the US called Barron's, and I think the headline was, what was it? It was, picking stocks is a very lonely business, doing your research, et cetera, and it said funds management is all about marketing, and it's really to get. The reason why you obviously talking about LICs and being at a discount, there's been quite a bit of conversations in the press over the last year or so about a number of them trading at discounts, and these managers, they've got to realise once they have an LIC, they're in a new world, and they can't just sit in their offices and do their research and pick stocks and just perform. They've also got to communicate, as you said, Bryce, really clearly to their current shareholders, but also potential shareholders about what the opportunities are. Yeah, and I think that's where they miss out. So to me, you guys are perfectly positioned to benefit from that.
Well, if you want us to come and be consultants for the new LIC,
Jeff
happy
does a
to
really
have that
good
conversation.
To me, we can talk about WAM Strategic, but when we talk about it, it'll be clear that you guys could have a role to play.
Well, let's talk about it, because the first we heard about it, I think, was about the stock ticker, and the press obviously had a field day because the stock ticker was WAR. So maybe for those who haven't read anything about it, can you tell us what the purpose of the fund is, and then how you're planning to, I guess, achieve that with some of the LICs that you're targeting?
Yeah. So it's called WAM Strategic Value, and what the focus of this fund is really to invest in undervalued assets, and mainly focusing on listed investment companies or listed investment trusts, and it's really to buy $1 of assets for 80 cents. Now, I personally have been doing it for 40-odd years, doing that. Yeah, as Wilson Asset Management, I've been doing it for 22 years, and what we thought is that we would simplify our business. Currently, we do this. We've got $150 million of exposure to 16 listed investment companies that are trading at discounts, but we do it in various funds. So what we're going to do is effectively sell them across to the new company. I mentioned earlier we're going to raise $225 million. And with that new company, that will be focused on buying $1 of assets for 80 cents, and it'll only buy them when I'm going to be the lead portfolio manager, when I believe that there's a catalyst that's going to change that valuation, and as you were sort of talking about before, you can actually have a situation where these companies, if they're just left and the managers manage the money and doesn't worry about communicating or shareholder engagement, they could just trade at a discount for a long period of time. So how do we do that? I would say I probably know as much about listed investment companies as any other person in the market. We've been able to successfully get ours to premiums, and how do we get that is really the four things I was talking about before, and really, how I see it is, we will take positions in other listed investment companies trading at discounts that we believe can get to NTA, and we really want it more as a partnership to work with them and get it to NTA, or it could be a little bit like, we're the jockey on a horse, and we're riding it, to win the race. Occasionally we might have to get the whip out and give them a bit of a whip, or like with these guys, we're happy to clearly explain what we do and let them see exactly what we do, and that's sort of the carrot side. And then if they do it, then they will achieve their goal eventually, and we'll be able to sell out at NTA, if not a premium. And if they don't, then we'll have to get the sticker bit. So, and the interesting thing about the code is it probably sounds a bit aggressive. So we see it more as a partnership, but we are happy, if we need to go to war. And there's been, we've actually made takeover bids for, 5 listed investment companies that, unfortunately, we might have used a carrot on them, and then we had to use a bit of stick, and then we realised we had to use a lot of stick. So for us as investors, it's really a simple play for us because we're buying $1 of assets for 80 cents, and if we can keep buying till we own 100% of the company. If we can buy it that cheaply, if they can't get it to NTA, ideally for us, I think the listed investment company space is fantastic. I want it to continue to grow and prosper. And ideally for us is these, the people we identify, we buy shares in, they're trading at a discount, they get it to NTA, we sell out, then they might take their eye off the ball or something happens, they go to a discount again, and we get another opportunity.
What will be really interesting is if you have a lot of success early days with this and close some discounts for LICs and the market recognises that, then whenever you take a position in an LIC, the market might be like, oh, Wilson's here, they're about to close the discount. And the market might be like, well, you're in and close the discount for you. It could become a bit of a self-fulfilling prophecy.
You've just revealed his strategy.
No. There is a bit of that. There is a bit of that. And maybe that was a little bit also, when we had choices for the, what ticker do we use, what ASX ticker, we thought, oh, look, maybe, even though how we want to operate is like we've always operated, and that's, effectively work with the company and, companies we own shares in. If you look at the prospectus, we use various examples. One that's listed at the moment, Templeton Global, we own 14% of that. It's trading at about a 10% discount to NTA. We started buying at a 18% discount to NTA. And we had been communicating with them over 4 or 5 years, and the latter part of last year they said, look, they're going to review their capital structure. So, something will happen there. There'll be a catalyst to give people liquidity at a fair price. When we did decide on war as the code, then we thought, with a bit of luck, it could be a bit self-fulfilling. But we don't want to. The good thing is, the market always provides opportunities. So, we don't want the market to be too efficient. And Red and Bryce, we've all been around long enough to know the market is never too efficient.
Yes.
Well, looking forward to seeing how this all plays out. The ASX ticker is WAR, WAR, for those listening at home who would like to also follow along. So, Geoff, you've been involved in a lot of advocacy and public policy work for shareholders, noticeably the franking credit campaign and virtual AGMs, which we love. What do you believe is the biggest hurdle, though, that investors are currently facing in Australia?
Thanks for the question, Bryce. And I don't know if I'd actually call it the biggest hurdle, but it's really something that we're very passionate about at the moment. And we've actually been passionate about this for a number of years. We put a number of submissions to the government, and that is really about levelling the playing field between wholesale or institutional investors and retail investors. To me, it's not fair that a company can raise money in a placement at a discount to NTA, and you've got to be a sophisticated investor to participate. If you're not that, then you can't participate on putting money in cheaply. But then when the shares come back on trading that afternoon or the next day, you can buy shares on market. And it's just totally illogical. Andrew Bragg, who's was back page of the Fin Review today in the Chanticleer column, he had an inquiry recently which we put a submission in there and we gave evidence. And so we really hope he's listening to us, and we really hope there's an opportunity to level that playing field. So every retail investor, every retail investor in New Zealand has the same rights as a wholesale investor. But for some reason in Australia, the retail investor is seen as a second-class citizen. Now, it's in our interests, as in fund managers, we get a benefit being the wholesale investor. But everyone who supports us, the 100,000 shareholders, they're the retail investors. So for us is, we're standing up for them. And, I really hope that, the government does, make changes and does level that playing field.
Yeah, we love that, Geoff. Obviously, Equity Mates is made up of a big community of retail investors, so we appreciate you standing up for us. And I don't want this to just be Bryce and Alec lobbying Geoff to get Equity Mates involved. But, if you ever want to, help get more retail participation in capital raisings, come to us and we'll get the community involved.
Dream come true.
Hey, good work, boys. But and just so you're aware, we're talking about war earlier. The issue, the IPO opens on Monday. So if anyone wants to go to the Wilson Asset Management website, then if they want to apply for some shares, then they can. So they've got 3 weeks to apply. So
right.
No, just a bit of free marketing in that side too.
No, that's great. That's great. Yeah. Now, another question that we do like to ask all of our experts. We've spoken to a number now on the show, and a lot of people stress the importance of management. And for retail investors, it's really hard to, I guess, get a gauge of management. We don't get to go to these company boardrooms, look the CEO in the eye and ask them the hard questions. So we'd love to get your thoughts on company management. What are some of the most important qualities you see in leaders that make them successful, and I guess then the companies they run successful? And as retail investors like Bryce and I, what should we be looking for in I guess public statements and press releases and stuff like that to get a gauge of who's a good manager and who's maybe not so good?
You're really making an assessment of that individual, and how can you assess them? It's really whether they meet or exceed your expectations, and it's really having a view on as you said, read the announcements, read the annual report, see what the managing director is saying, and see whether he achieves, meets or exceeds those expectations. Listen to the AGMs, and potentially attend them if you can. That's why we were very vocal when they were effectively, the government was or Treasury was talking about just having virtual AGMs. Now I know virtual AGMs are fantastic because it gives everyone access, and I agree with that happening, but you also need to have a physical presence, because otherwise, the management, they can cleanse the questions, so they can only answer the questions they want to answer, and you want to be able to put them under pressure and see how they perform. I'd also, I would read, the gossip column areas, because they're the ones that really, dig in deep in terms of what management may be doing or may not be doing. And so you can take an assessment from that. And also, to me, it's very important that people have skin in the game. So, if someone's managing a company on your behalf, you want them to have a decent amount of their wealth invested in that company. So, to me, you look at, there's some various things you look at.
So, Geoff, before we just briefly chat about a stock that is on your watch list, we will quickly hear from our sponsors. So, Geoff, we'd love to chat to you about a stock or an idea or an industry or even an LIC that you're particularly excited about or is on your watch list at the moment. So, is there one that you'd be happy to talk about?
Well, there's a couple, and that I think are cheap, and because we're talking about war and we're talking about listed investment companies, and why not chat about a couple of those? Yeah. One is there's a listed investment company, Thorny Opportunities. The code's TOP. That's managed by Alex Waitsless. Very successful, billionaire. And it's performed exceptionally well. It's trading at a significant discount. It's 20% plus. So you're buying $1 of assets for less than 80 cents. The question is, what is the catalyst that's going to that will get that share price, move it up from that less than 80 cents to $1? And that's the harder part, because the question is, it's really how committed Alex and his team are to engage with shareholders. They're doing a fantastic job as investing, but how quickly that discount narrows is really how quickly they communicate with shareholders, they rust on their current shareholders, they tighten up the register, and the share price moves to NTA. Now, that will happen over time, assuming they continue to perform as they have. So if you've got a medium long-term view, to me, I think that's a great buy. More short-term, the question is, how committed is Alex to doing that? And hey, I was meant to catch up with him a couple of weeks ago. I missed him. But that's the $1 million question. I'm sure he'd like it trading at NTA, if not a premium, gives everyone more flexibility. But and I'm sure he'll get there, but it could just take a little bit of time. The other one is another LIC, LSF. That's L1. It's trading at about a 15% discount, so you're buying $1 of assets for 85 cents. They are like a 130-30 fund manager, so they can be long and they can be short. So there's a little bit more risk in that. But they, to me, they're doing a lot of the right things. I was speaking to Rafi Lam, one of the managers, a week or so ago. They have been buying back shares, which the retail investor tends not to like that because they think the manager doesn't know what to buy. But it's logical from a capital management perspective. If you buy $1 of assets for 85 cents, that's logical. And I was saying to them, look, you really got to. They've got a really good profit reserve, and I said you've really got to push the dividend a lot harder. We have small positions in our LICs in both those. Why don't we have bigger positions? It's probably because we're not sure about the timing for top, when the discount will close. So if you're taking a long-term view, then don't worry about that. And also for L1 is they did have a pretty tough year a couple of years ago, and they have had a really good period over the last 12 months. And so they're really a high beta manager, so they can go exceptionally well, but then they can mean revert and not go as well. So if it was a bigger discount, and to me, there is a reasonable amount of froth and bubble in the market. So if the market, the market could come off a little bit. So we've got a little bit of position there. When we're more convinced they're going to push the dividend harder, then of course we'd increase our position, because then if they did push the dividend harder, I'm pretty sure they'll get to NTA a lot quicker.
Yeah, nice.
No, I like that. So, Geoff, we first of all want to thank you for taking the time to talk to us. We do have a final three questions that we like to finish all the interviews with. But before we do, just a massive thank you. It's pretty exciting for Bryce and I to get to speak to you. And, we're very excited to see the launch of the 8th LIC, the Strategic Value LIC. If people want to follow, hear more about you or follow you online, is there anywhere in particular they should be going?
It's the Wilson Asset Management, .com.au is our website. And we do weekly emails. As I think I might have mentioned earlier, we've got about 60,000 people on that email list. So, we do weekly emails communicating with people. And then if there's anything relevant about, WAM Strategic, etc., we try to communicate as we try to be sort of the gold standard with communicating with shareholders. So, if they just sign up for the emails.
Great. So we'll get stuck into these final three questions. The first one is, do you have any books that you consider must-reads?
One of the books I love, and it is a bit old now, is the Peter Lynch book, One Up on Wall Street.
Great book.
To me, it just talks about the competitive advantage that everyone's got. And it was funny. I was giving blood a number of years ago, and the lady who was taking it said, "Oh, look, why were you? What area do you work in?" And I said, "I'm a fund manager." And she said, "Oh, I invest in the stock market." She said, "I know nothing about the stock market." And I said, "Oh, who do you work for?" And she said, "Oh, Sonic Healthcare." And I said, "Well, that's listed on the stock market. You know more about Sonic and their management than I do. And I said, what do you think of their management? And she was just saying they're exceptional. So, like, everyone's got their own little competitive advantage, and it's really, particularly as you said, the millennials these days, they know you guys think a certain way. I'm thinking in the baby boomer way. So you guys have got a significant competitive advantage, and particularly things like with Afterpay, which has been a great success now. But in the early days, you guys would have seen it, thought, oh, hey, look, this is really going to take off, and it's trying to use that competitive advantage. I do like that book. I mean, all the Buffett books, snowballing, or all the historic investment books, they're all good value.
So the second question is, in 60 seconds or less, what's the best company you've ever come across?
Yeah, I actually think it's the Australian Securities Exchange, the ASX.
Nice.
Well, to me, it's like, in theory, I know it's not a monopoly, but it's pretty close to a monopoly. Volumes grow at well and truly in excess of GDP growth each year, and like, it's just like a money printing machine. That's what I think. So it's the ASX.
Yeah, great. And then final question: if you think back to your younger self, buying that first share in Timor Oil and Gas, what advice would you give your younger self?
Well, I'd say don't buy that. I'd say, like, do some research, and don't like sort of just get a dart and throw it at the board, which I did. And find a company that you think will grow over time, and actually commit capital on a regular basis. I think one of the things that I should have done was invest in the market over time, and then you get that benefit. We all know Warren Buffett talks about the benefit of compounding, and the reason he's worth what he is he started with a small amount of money in 1965, and it's worth billions of dollars because it's just grown at 18% per annum over that period of time. So, if to me, that's effectively the advice for my younger self.
Nice. Well, great way to end there, Geoff. As Alex said, a massive thank you for your time on Equity Mates today. A reminder, WAR, WAR, is the ticker for the new LIC coming. But look, we really appreciate what you're trying to do for retail investors and the lobbying and advocacy work that you're doing out there. And, it's similar to what we are trying to do here at Equity Mates on a much smaller scale.
We don't quite have a lobbyist yet, but maybe one day.
Maybe one day.
I think it is. And to me, like, it's amazing, we're like together, what we can achieve. So, don't worry. We'll be finding you next time. Like in terms of with franking credits. Of course, that was a big strategy for us, is just trying to be fair and equitable to everyone on that. And you guys are beautifully positioned in a fantastic niche, or not actually niche, a fantastic segment of the market, we well and truly may call out for you guys to use your muscle, to put pressure on, whether we need to pressure on Senator Bragg and that to get the result to make it fair for everyone. So look, thank you for putting your hand up for that.
Well, let's go hard at the capital raising side of things. I reckon that's where we'll be able to. Well, that's what I'm passionate about anyway. But anyway,
excellent. No, that's it. That's to me. That's what we're focused on. So,
nice.
Our people will be talking to your people soon.
Well, perfect, because we have heaps of people in the team. No, Geoff, look, appreciate your time, and as always, welcome back on the show. So have a good evening. Right. We'll talk later.
Thanks, guys.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing podcast are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people today.